think we're going to have a good presentation, and you'll have something to look forward to here. I want to just say very briefly a quick plug for the El Dorado Community Foundation, not just because I'm on their board and their president, but they do an excellent job. The foundation supports charities in El Dorado County and is a resource for advisors and donors for structuring planned gifts. So if you or anyone you know had questions on how to structure planned gifts or wanted to know more about giving locally in our community, then I invite you to contact the El Dorado Community Foundation, and you can check out their website at eldoradocf.org. Also want to acknowledge the Planned Giving Committee. The Planned Giving Committee is part of the foundation. We are instrumental in getting this presentation today. Unfortunately, we couldn't host our normal annual event at Serrano. I miss seeing all your bright shining faces there, but we'll just have to learn to live with the new normal. So in lieu of that, we're going to have a discussion about the CARES Act today. And we'll talk about some of the additional webinars and presentations we'll be rolling out later this year and early next year. So speaking of which, I'd like to talk to you just very briefly about our presentation coming up in October. If you've ever wanted to read tomorrow's newspaper, if you ever want to see around the corner, if you will, then you're in for a real treat if you come back with us in October. We have a speaker who will be visiting us then, who is a consulting futurist. He's a strategy advisor and a leadership educator with 33 years of experience in his field. He spends most of his time with governance and top management and planning and decision-making meetings. His clients include Gillette, Berkshire Hathaway and Motorola, regional banks of the Federal Reserve and the National League of Cities, and also a wide cross-section of clients in financial services, agriculture, information security, and telecommunications. He has lived in the Sacramento area for several years and has presented to many local institutions, including the Los Rios Foundation. He's here to preview an October 8th webinar for advisors focusing on the 10-year future. It is my pleasure to introduce you to Mr. Bob Treadway.
Thanks, Dan. Appreciate it. Hello to all of you out there. I'm going to slip away once I do a couple of minutes to preview what I'll cover in October and listen to Dan's wise words about the CARES Act. I thought I'd give you a little bit of a preview, and my thanks to Dan and to my old friend Chris Rieg, as I understand it, for inviting me to come back and share my views about 10 years from now. This is right up my alley. I'm going to share a few visuals with you just to give you a flavor of what's out there. These will come quickly. There's about a dozen slides here, and you may want to see more about them. Hopefully you'll revisit us so you can not only see them again, but also get a copy of them from me in October. I love the 2030 date. When I surveyed the committee to ask them what sort of questions they might have about the next 10 years or so, these were the things that came back. And I think many of you in the audience can identify with these things. This is up my alley. And I'm not going to say that I'm going to address every one of these in the hour or so that I'll present, but I'll give you some good ideas on these and give you some approaches that I think you can use. One of those is to look at the future not as a prediction, but as something that you want to forecast. Forecast is different than predicting. It's taking uncertainty into account and changing your forecast with time and new information. So I'm going to show you a cone of relative certainty for what's out there ahead of us that I think will cover a number of different topics that I think will be of interest to you. The committee has rank ordered those in terms of what it is that they think have the highest importance. These have come out as some that I'm going to try to address, and I'll give you just a little bit of detail in a couple of these areas as we move through this material. But I hope you'll find this compelling and interesting enough to come back. I'm not normally in the habit of quoting Lenin, but I thought this quote from back in the last century was applicable to what it is that we're seeing today. Many of you have curiosity about what we'll see after this pandemic in terms of things that will carry into the next decade. I'll try to do that. In fact, this overall idea of thinking not only about what happens, but also the after effects, the implications, the ripple effects, the consequences, the results of what's happening is something that I'll try to help you develop some skill in and try to give you some examples of. And let's take one of those because everyone's kind of interested in what automation and computerization means to your profession and your jobs and your firms. There was a very interesting peer-reviewed study by a couple of very bright fellows at Oxford that was done in 2013. I'm not sure many of you are familiar with it, but I'm going to show it to you and show some results of it in just a moment. This has been followed up by several others, including some from more recent years. This said that about 47% of US employment is at risk of being computerized, and I think that's valid. Some cities will see the effects of this more than others. I'll try to give you a list in October. But here, for instance, is a set of just a few examples from the paper of jobs, professions. They use the SIC codes, focused it on America. These are the high probability of computerization jobs. And I hate to have my loyal advisor, trusted advisor accountants looking at this, but there is the possibility that a 94% chance of accountants and auditors being automated at some point in the future. Dan just joked with me about bringing on the robots, but there is a way around this. And for many of you that are affected by this sort of thinking, this does not mean it's going to be tomorrow. It may not be in another decade, but at some point, this is the probability of it. Low probability, things that will very probably not be automated. You can look down this list and see that attorneys figure in, CEOs. I always put this in presentations to clients because it usually helps me form a bond with the C-suite. But we'll get more into detail on this when we come back to it in October. These things that have been bubbling under and we've been talking about for some time in terms of artificial intelligence are actually in our face now. Analytics and automation are literally there to be used, to be manipulated, to, in some cases, be used over wireless communication, something that I think COVID is going to hasten. 5G mobility is going to be in our infrastructure in the next 5 years. This is the ability to see broadband throughput, the kind of thing that you get in a 1 gigabyte connection in your home or your office, but you'll be able to see it on a mobile device. This is coming. It's here. It's planned. In fact, here in San Diego, I'm right now about 150 feet from a 5G installation that's going up on a building in my neighborhood. This is going to enable the tech competitors to come at you in an even bigger way. I have a lot of clients, especially in financial services, that are facing the same things you are. I'll try to give you some advice and ideas on the best ways to compete and how to treat these institutions and firms. We're in an unprecedented time for social change, political change, potentially. I don't know what's going to happen even in the next election, but some of the things that we can look out farther on, and I've been doing this for quite some time, beyond 2024, we can see what the political tendencies are in America and what that might mean in the future. In the Los Rios presentation that I did back in 2003, I believe that was the year I did it, I pulled this slide because I was talking about the ethnic shift in California. And here's an updated slide of what's happened in non-white population in many states. Those in blue voted for Clinton in the 2016 election, red voted for Trump. This is what's going on in America. This is a societal change that we'll want to think about and consider as it relates to not only overall society, but regulation, legislation, et cetera, that affects many of your positions. I also used this slide when I was presenting back in 2003, which shows that a high concentration of retireds and elderly in the counties that you serve and operate within is something that I'd like to retouch on and update, and then to talk to you for a bit about how retirement is not what it used to be. And for those of you that are advising clients and considering planned giving by them, might want to consider how long they'll continue to stay in the workforce and what that means to your own professions and your own businesses. So I appreciate having the time to be able to share a few of these things. I'll look forward to not only seeing you October 8th, but answering your questions. I should have about 30 minutes to do that. I'll share my visuals with you. I appreciate the opportunity to come back and be with you and give back to the Sacramento region that I've enjoyed immensely during my time there. So thanks very much. See you in October.
Thank you, Bob. Appreciate that. Definitely looking forward to it. I will say that if the robots can get in here sooner than later, I'd appreciate that. I've had one day off this year, and that study's 7 years old, so they need to get this going. I'd like to get some more time off. So thanks again, Bob. Bye. All right. So let's get into the presentation here. I want to talk about go into a relatively deep dive into the CARES Act. This was legislation that was passed in March 27th. Just gosh, it feels like it's been 2 years, not just a couple of months. The speed at which this legislation got passed was impressive. And anytime they pass legislation quickly, it's prone to errors, it's prone to interpretations, it's prone to revisions. One thing we can expect moving forward is continuous interpretation and change. But for now, we've got a framework of some law changes I think you're going to find interesting that will apply to your clients. Trying to get this to... Well, technical, there we go. All right. So here's some issues I want to discuss today. And now you should have something to click on your screen. Again, I'm relatively new to Zoom, so I'm figuring this all out, but and able to ping me a question. I'd be delighted to answer questions as we go. I expect to speak for about 45 minutes and then have time after for any questions that you might have. But if there's something on your mind, ping me now. I'd be glad to make it part of my presentation. So what I want to talk about is, here's the list of items that I think are important. No discussion about the CARES Act would be complete without mentioning the PPP loan program. We'll talk about some changes in retirement and IRAs and some opportunities to do some planning for your clients. We'll talk about the stimulus payments. Got lots of questions about that. There's been some changes to charitable contributions. And then the last three provisions here on excess business losses and the changes to the treatment of net operating losses, and then the retroactive fix for qualified improvement property. In terms of the dollars involved in tax planning, the opportunities for, at least for my clients as a CPA, this is really where all the big dollars are. These are where all the big savings are and big opportunities. And I'll walk you through some of the examples on that. But definitely this is where accountants are seeing opportunities to save our clients a lot of money. All right, so let's talk about the PPP program. In the history of three-letter acronyms, I don't think any three letters have gotten more attention and more notoriety than PPP. I don't know when RIP and LOL came out, but I do know when PPP came out. And if you mention those three letters, I promise you, the person you're speaking to will know exactly what you're talking about. So the PPP program, or the Payroll Protection Program, was a $600 billion fiscal support for small business, right? And small business was defined as any businesses that have fewer than 500 employees. And then we found out, just based on some public disclosure information, that not every industry was limited to 500 employees. Restaurants in particular could count their employees by location, but 500 employees was the number, right? And the most you could borrow on the PPP loan was 10 million. So if you had 500 employees, each making 100,000 or more, right? And in 2019, then you could have qualified for a loan for around 10,400,000. So there's a reason why 500 was the number and 10 million was the cap on the loan. Now, there was a stampede of clients going to banks. So if there's any bankers in the audience or listening in, yeah, I was getting texts and phone calls at 10 o'clock or 11 o'clock at night from bankers, and sometimes 10 o'clock and 11 o'clock at night on a weekend, asking for information for clients to get these loans processed. It was an amazing amount of time they had to put in to meet the demand. And I knew when I read this legislation, I knew when this came out, that the program would blow up, if you will, and there would be an extreme rush to get applications in to be part of this program. And why was that? Well, the big carrot on the stick on the PPP program is loan forgiveness, right? It's one thing to get the loan, it's another part then to get the loan forgiven. That was the important part. And we'll get to that in just a moment. So when you did your PPP loan calculation, it was based on 2.5 months of applicable payroll. And so that payroll amount was limited to 100,000. So employees who made more than 100K, you capped them at that $100,000 number. So it effectively meant that for any employee who made more, including the owner, but anyone who made more than 100,000, the loan amount was $20,833. So basically per employee. That's 2.5 months at $8,333 per month, right, for 2.5 months. Now, in that calculation of the loan, you can include health insurance and retirement. That included health insurance and retirement for the owners. And it didn't, and at first it wasn't necessarily capped at 100K, and it's not capped at 100K for those who are not owners. So the numbers got fairly substantial. They had special rules for partnerships and sole proprietorships. They kept rolling out interpretations on how to make this work, right? And so we all had to deal with a framework that initially was all over the board. I saw multiple copies of loan application or loan calculators from banks, and they were including things like FICA and Medicare taxes. They were including workers' comp. The calculations were all over the board. And I can promise you that a number of those calculations were just simply wrong. And the banks approved it, and the SBA approved it, and they were, and off you go. So again, it was one part of the process was getting the loan, and then the real carrot on the stick again was the forgiveness, right? And there's the opportunity to not have to repay it. That was the part that was so attractive. Now, here's a very black and white table of loans issued as of about, I think this was about a week ago. It gives you the dollar amount, gives you the size of the loan and the number of loans. And so you can see the vast majority of the loans were for less than 50,000. That's 65%. And if you look at 100,000 or less, it's more like 80%. So the idea that these loans went to small business is played out, right? And it means that the amount of opportunity for these smaller businesses to get some relief, to get some much needed capital was certainly provided by this program. Now, if you look at the row for 350,000 to $1 million, you'll see that the greatest number of dollars were issued for that loan amount. And I would say in my experience as a CPA, then I would say the vast majority of my clients had loans in that range, right? Now, I had some who were between 2 million and 5 million. And I had I think I had one that was closer to the 10 million. It was around 9.7. Now, the reason that I mentioned the 2 million number is because there was an FAQ put out by the SBA. And when you did your application, the only criteria that was maybe troublesome that you had to certify is that you had the economic need due to uncertainty in the market to apply for the loan. And that's all you just had to initial and sign and send it in. And then it came out that some businesses that would otherwise have access to large amounts of capital, they're publicly traded, they just have fewer than 500 employees, were able to get PPP loans. And Ruth's Chris was a good example. Now, the Los Angeles Lakers are not publicly traded, but they certainly made the front page for organizations that got PPP loans that perhaps some felt was not necessary. Although I will say that I can promise you the Lakers are losing money right now because I don't think there's been too many games on recently. But the SBA came out finally and said, we're going to limit our audit resources to loans for 2 million or more. And so they said that we reserve the right to audit those who had loans for less than 2 million, but they're pretty much saying that if you had a loan for less than that, then you met the economic uncertainty criteria for getting the loan in the first place. And if you're above 2 million, then you can expect to be audited. Basically they have a finite number of auditors. I think they have 90 auditors. And if you add up the column that reads the loan count and do some math, you can get an idea that each auditor would have to audit 50,000 loans to audit all of them, which is clearly not the case. So if you or somebody you know has a loan for 2 million, then expect the audit and be prepared for it. If your loan is for less than 2 million, then basically you have no issue. And this is where maybe I had a problem with the program. It was not tied necessarily to economic need. In fact, for some of my clients who were shut down, the idea of doing a PPP loan when it first came out was not very appealing because they'd be paying employees who are not making money for them. They're not doing anything. They're simply sitting at home. And so to do that, it was going to cost you the Social Security and Medicare taxes, and you'd be matching it for having employees not working. So a lot of them were on the fence for even doing a PPP loan. But my clients who were otherwise still productive, in fact, some still profitable, they found this as an opportunity to, well, I'll just say an opportunity they couldn't pass up, right? So again, there's multiple folks who got loans that perhaps in my opinion they didn't necessarily need, but we're dealing with a set of rules. So then there was a first tranche of loans went out, the money dried up, a number of folks couldn't get in on it because of either they're working with large banks who couldn't get their programs going fast enough, or some local banks who just simply weren't participating in the program. And then the second wave, or second tranche, if you will, of funding came out, right? It's another $300 billion. Now, if you added up the net dollars column there, you'd find that totals about $510 billion. Well, $610 billion or so is allocated to the program. Doing some very basic math, it tells me there's $100 billion still left. And I've spoken to a couple of the bankers in town, and they're frankly now doing fairly small loans, or those who've always sat on the sidelines. So if you were ever contemplating doing this, then there's still money available. And I think based on the most recent update to the law last week, I think you have until the end of June if you want to still continue to get one. Okay? All right. So then in terms of, again, the important part of this is the loan forgiveness. It's one thing to get the loan. It's another thing to not have to pay it back. And the banks don't want to have it on their books either, right? They don't want to have a 1% loan. That's what it would become. If you receive PPP money and we're not able to get it forgiven, then you basically have a loan now at 1%, which I believe now it's adjusted to 5 years. So they keep bouncing this thing around. Now, one of the changes they made just last week was the period of time in terms of the measurement for forgiveness. So your original loan was based on payroll, retirement, and health insurance for 2.5 months. The forgiveness originally was based on 8 weeks of payroll, rent, mortgage interest, utilities, and well, I guess it's a payroll, mortgage interest, rent, and utilities. And a lot of my clients made decisions about how to spend money, thinking they had 8 weeks to spend it, which was the rule up until last week. And the initial loans on these came out in early April. And if you do the math on 8 weeks, then many of the loans were coming due as of last week. So they had to make a decision on even submitting for forgiveness. And for the last 2 months, we're making decisions on how to spend money. Well, now you can choose to use a 24-week measurement period. Frankly, it really means to me that anyone who got a PPP loan will find it almost impossible not to get it all forgiven. You'd have 24 weeks to get these amounts paid out. And they lowered the threshold for the amount that had to be paid for payroll. In other words, 40% of what your cost of your loan to be forgiven can now be for something other than payroll. It could be for the rent, the utilities, or mortgage interest payments. Now, just a couple of quick notes on this. Now, mortgage interest payments, that's interest secured on loans by real and personal property for your business. So it could be for financing costs on equipment, if you're paying on your equipment loans. It would not include interest on a credit line because it's not secured by the property. Now, rent payments had to be for leases in place by February 15th. There's a whole number of rules that go into this. And I don't want to sort of get out into the weeds on this unless you want me to. But suffice to say, as long as you're maintaining your full-time equivalent employees during this measurement period, and that full-time equivalent measurement is compared to what you had back in between February and June of 19, or January through February of 20, whichever one is lower, whichever is easier for you to meet the criteria. It's as long as you're maintaining your number of employees, basically not slashing wages for those who make less than 100,000. You can continue to count out what you're paying out and simply go and get this all forgiven within 24 weeks. Now, if you want to stay up to date on this, I've given the link for the website of Treasury. For a while, I was simply waking up in the morning, turn off the alarm clock, walk over to the phone, search PPP update, and see what was happening. Now we have 24 weeks. I'm not nearly as concerned about this issue about the forgiveness. So, all right. So that's the PPP program. Again, a great program. It really helped a lot of my clients. The ones who are over 2 million in loans definitely need to consider making sure they're crossing T's and dotting I's. With a 24-week forgiveness period, all of them will basically get this forgiven. I can't envision too many that would have the problem. And again, that's the value. So a couple other quick notes, and I guess I should tie this back to tax issues. When the forgiveness rules first came out, the IRS said that the loans were tax-free. I'm sorry, the forgiveness was tax-free, right? They were very clear about that and made kind of a big deal about it. And I was thinking, well, gosh, if the loan forgiveness is tax-free, then I'm going to have a huge loss for some of my clients that had millions of dollars in these loans. When they came out and pointed out that, the IRS came out and pointed out that the expenses associated with tax-exempt income, I think it's under Section 265, those expenses are not deductible to the extent they're associated with tax-exempt income. Now, what does that mean? That means effectively your forgiven loan is taxable, right? But Congress said it was tax-free. This is effectively taxable, though, based on the interpretation of that particular code section. So you might see a change here. It may come out that those loans are truly tax-free, and you can deduct the rent, utilities, payroll, retirement, and health insurance you're otherwise paying, right? Because the only way to get forgiveness was to pay for expenses that are already deductible. So you couldn't get forgiveness anyway unless you were paying for those items. So there was no point in telling us if it was tax-free. It's not. And Congress was considering changing that rule. Now, to me, it may be a bridge too far. It's a $600 billion program, and we can assume that pretty much all of it's going to be, let's say it's all spent and all forgiven, then if they made that truly tax-free, then what, 25% of the loan forgiveness? That'd be the amount that the government is missing out on by not effectively taxing these PPP loans. Right? I just think that's, I heard this morning we're at what, 25 trillion for our debt? And that's as of this morning. Maybe it's more this afternoon. Who knows? Okay. So I don't think that law is going to get changed. I think it's going to remain the same. All right. So I want to talk about another item that I've gotten a lot of questions on, and there's some planning opportunities and maybe some misinformation out there. And it's related to distributions from an IRA or retirement for what they call coronavirus-related distributions. And so what they've given you is the opportunity to withdraw from either an IRA or a qualified retirement plan, and then either pay it back over, I'm generalizing here, we'll get to the details, pay it back over 3 years tax-free, right? It's a rollover, or pay tax on it over 3 years, and you'll pay tax but avoid at least a federal early distribution penalty. So a lot of information there, right? And so the $100,000 withdrawal amount is per person, and it's aggregated between IRAs and qualified plans, right? And so in general, what the And the basic rules are the distribution has to be made in 2020. Now, I'm very clear on telling you that that's for the full year, right? We'll get to that in a moment. It avoids a 10% early distribution penalty. The distribution is not subject to mandatory withholding requirements. This would be an issue for distributions from 401ks and employer-sponsored plans where withholding is mandatory. It can be repaid over 3 years, and the income can be spread out over 3 years as well. All right, so in order to qualify for this, you have to either have experienced health and or financial impacts as a result of the virus. Now this, unfortunately, there's not a lot of detail on this. And my thinking is that eventually it's going to come out that any distribution from your retirement in 2020 will not be subject to the 10% penalty. Now don't quote me on that and say, well, Dan said there's no penalty. The law hasn't changed yet. And you do have to jump over some very low-lying bars to get there, all right? So the first one is that either you or your spouse or dependent is diagnosed with COVID. And it has to be a CDC test. Now, we all know that person who swears up and down that they had COVID, right? I said, oh yeah, back in January, I was so sick. I had a fever, you know, and the stories get larger than life, right? Oh, I had a fever of 112. If I tried to blow my nose, the tissue would spontaneously combust. I know I had COVID. You know, I was projectile vomiting for 12 days straight. And if you do look at the testing percentages, at least in Sacramento, my understanding, the positive test rate's around 2%. So 98% of the time, you probably didn't have it. But maybe this is a reason or the impetus to get tested, right? So if you or your spouse or kids, one of you has COVID, then either spouse could take out $100,000 out of their retirement and meet one of these rules, right? So I'm not suggesting you go out and get COVID, okay? But I am suggesting perhaps get tested, all right? But before you do that, just know that there's other methods for meeting this requirement. It's not simply having the virus. Now, the other requirements are you were quarantined, furloughed, laid off, or having work hours reduced. I don't know where quarantine is defined. I'm not sure exactly what that means. Was it me self-quarantining? Is that the shutdown, the shelter in place we had? I don't know. Did I have a fever? My employer told me to go home. And to what extent are my work hours actually reduced? My employer said that we'll go from 40 to 30. These things are undefined right now. If you had to close or reduce hours of a business, is it your main business? Is there more than one? You're unable to work because of lack of childcare. For how long? So you couldn't work on Friday because the nanny you used couldn't come in, and therefore you were unable to work. What if you're self-employed and you work at home? There's no description of how this works. And then the last bullet point is meet some other reason that the IRS approves, right? And there's, at this point, they're considering public comment. So I think what's going to come out, and you can see almost the how they started with, well, if you have COVID, we'll give you a break. Well, then maybe you have your spouse, or your spouse and your kid. Well, maybe you had some financial problems, and then we'll get back to what those might look like. And so I've given you the hyperlink for the FAQs issued by the IRS. I think they're informative. They'll give you some information on some of the issues related to this, okay? All right. So it's a $100,000 aggregate limit from all plans. So if you withdrew $75,000 from your IRA, you could pull $25,000 from your employer-sponsored plan, assuming you can get to it. And we'll talk about that in a moment. So in total, the $100,000 you pulled out would be subject to this new rule for coronavirus-related distributions. And it must be made in 2020, but it applies to any distribution this year. So if you took a distribution in January or February, this rule could still apply. Right? And I'll get to an example on that. So it can fix RMDs and other pre-CARES distributions, which give us effectively a time machine. Again, this is something you took out in January. And you suddenly can go, well, I think I can avoid this early distribution penalty and spread the income out over 3 years. Or put it back in within 3 years. Now you've got lots of options. Now this rule applies to 401k, 403b, 457 plans, all the employer-sponsored defined contribution plans. But not all employers have plans that would allow for in-service distributions or even hardship distributions. So it may require an amendment by your employer. Okay? And it may also provide an opportunity where money could come out of an qualified plan under a hardship distribution and be rolled back into an IRA. Get it out of your employer's 401k and into your IRA. Normally you can't do that. You normally have to go back to the employer plan. But you might have the opportunity to get this back into an IRA. All right, let me give you a simple example on this. Let me give you a simple example on this. So Sydney, 35, takes a $90,000 IRA withdrawal on January 2nd, 2020. Being completely distracted by the impending pandemic, she forgets to complete the 60-day rollover. And what are her options? Well, option number one is to go ahead and pay the tax, pay the penalty, and be done with it, and make it be a hard lesson for not paying attention to your financial affairs. All right. Or two, consider the CARES Act criteria for a coronavirus-related distribution. In other words, implement the time machine. So in this case, Sydney could designate this distribution as a coronavirus distribution. And this is all based on self-certification. Especially when you're submitting to an employer, right? They're not going to check to see if you've had a health issue. They have to assume that it's correct. And out of the IRA, your distribution is going to look no different than a regular distribution at all. And there'll be forms to file in 20, 21, 22, and maybe even 23 to account for how you're recording this distribution. So she could then consider reporting the income entirely in 2020. That's one option, or you can spread it out ratably over 3 years. It's either one or the other. So if you consider repaying the IRA within 3 years, in Sydney's case, it would be, she'd have until January 2nd, 2023. She can pay any amount up to the $90,000. She doesn't have to repay it all. And to the extent she short pays it, if she only pays in $45,000, let's say, then the $45,000 she's short is then taken as income ratably over 20, 21, and 22. And so what they effectively do is they treat this as if you met a 60-day rollover requirement for any contributions back into, in her case, back into her IRA. All right? And now why is that important? Well, that's important because you may have more than one distribution in a given year. And this is capped at 100,000. Maybe you had reasons to take additional amounts and you were doing a 60-day rollover, right? You take money out, use it for 60 days or for whatever reason and roll it back in. All right? That's a rollover. This is considered, repayments of this is considered a trustee-to-trustee transfer. So effectively what you do is Sydney would have to report a third of the income in 2020, a third in 21 if she makes this election, and if she repays it all in 22, then she has to go back and file amended returns. So for a couple of years there, you're out the tax on the amount that you spread out over the 3 years before you made your reinvestment back into your retirement or your IRA. Okay, so again, I think there's some good planning opportunities for clients on this. I think at the end of the day, really, they're going to eliminate the 10% penalty issue. They're simply going to say, look, you can take a distribution out in 2020, and you'll have 3 years to get it back in. And to the extent that you fail to do that, then you'll pay income tax ratably over those 3 years, and then life will just simply go on. So. All right. So the CARES Act also changed the 401k loan limits. Okay. So now you can take, under the old rules, you could take up to 50,000 or 50% of the vested interest, right? Whichever was less. Well, now they've adjusted that to 100,000, the lesser of 100,000, or 100% of your vested balance. And this would apply to loans that are received by September 23rd of 2020. Now, any existing loans that you have, the payments can be deferred. All right. So then on loan balances outstanding between March in December of 2020, those payments can be delayed and pushed out for up to 1 year. And if you do that, then your loan just simply gets re-amortized and you start paying on the new loan. The interest on the loan continues to accrue. Again, the loan terms can be extended for 1 year. Now, does it make sense to take the loan, or does it make sense to do a coronavirus-related withdrawal? All right. And so I always have some issues with the loans, right? And so let's say you do the loan and you're unable to pay it back, right? So then what happens? Well, now you've got a distribution that is subject to perhaps early withdrawal penalty, right? And you've just kind of shot yourself in the foot. So I think if you know, I guess with the loan, you're actually repaying it back. But if you fail to meet those terms and you have all the same issues you had before in terms of taxation of failing to meet a loan repayment, okay. All right, a little technical difficulty here, just bear with me. All right. So let's talk about RMD waivers. So that's another item that came up this year, was the opportunity to to waive your required minimum distribution for 2020. One of the problems was we didn't know about that until the CARES Act came out, and many folks had taken distributions prior to March 27th, before we even knew about the rule. So what can you do? So any IRA distributions taken out after February 1st of 2020 can be rolled back to the IRA as long as you do this by July 15th of this year. This is an Internal Revenue Notice 2020-23. So you have the opportunity again to, if you want to push these back into your RMD, back into your IRA, you have the opportunity to do so. Now, the waiver for RMDs applies to 401ks, applies to 403Bs, the 457 plans, anything that has a required distribution. It does not apply to the defined benefit plans. So, so anything that requires an RMD, it applies to Roth IRAs. It also applies to inherited IRAs. Any of those can be deferred. I can't think of any reason to not do it. All right. So it's as if the existing RMDs can be rolled back into your plan because the RMD just simply does not exist for 2020. You can take your RMD and roll it to a Roth, which you normally can't do, again, because the RMDs do not exist this year. But it's got to be done within 60 days, right? So if you took out your RMD in March, then you're beyond your 60-day period to roll it to a Roth IRA. All right, and those are things you want to discuss with your financial advisor. All right, so stimulus payments. We'll talk about this briefly. The amount of questions I got relative to the amount of income this creates, frankly, not a lot of my clients get it, but enough of them do, where I've had lots of questions, and there's a lot of misinformation out there. So stimulus payments went out for single and married filing taxpayers at different thresholds, and you'll see those on your screen. Now, keep in mind that the stimulus payment is simply, if you got one already, or if some of you know did, then that was an advance payment on your stimulus payment that's due based on your 2020 returns. So if your AGI, now they initially said if your AGI for 2018 was 150,000 or less, and let's say you're married, then they would pay out that stimulus payment if you hadn't filed your 2019 return. So some folks held on to their 2019 tax returns knowing they're going to be well above the threshold if they met the threshold in 2018. And the converse was true, where if you were well over the threshold in 18, you could hurry up and file for 19. And if you were going to be less than the thresholds, then you would get your stimulus checks as well. Now, if you had to get those in sometime back in May, so if you missed the boat, then you're stuck with whatever your returns are for 2020 in terms of meeting the thresholds. Now, maybe you have an opportunity to do some planning. If you do meet the requirements in 20, but you did not meet it for 18 and 19, then it'll be considered as if it's a payment on your tax return. And it'll be it could be a refund or a reduction to a balance due. Now, you had to have filed a tax return to get it. Unless your only income was Social Security, or you were receiving Social Security, I should say, and then you made payments out based on that. All right. Now, if they overpaid you in 2018, because again, this is a 2020 stimulus payment, it's supposed to be based on your 2020 income. So if if your income's high in 2020, they effectively overpaid you because they based it on 2018 or 2019. There's no clawback. They're not going to take this money back from you. They're not going to bill you or charge you for it. They just simply overpaid you, and that's what it was. I got I got a number of clients who said who they were executors, they were trustees, they had a parent pass away, and they received or a relative, and they received a check, a stimulus check. And literally millions went out like that. And so if you do receive that, or if you know someone who did, it's supposed to be repaid, and there are instructions from the IRS on how to do so. It's not just an additional stimulus payment. All right. So then there's some minor changes to charitable contributions. Okay. You can now donate up to 100% of your AGI if the donations are made in cash for cash contributions. The previous limit was 60% as of the Tax Cuts and Jobs Act. Before that, it was 50%. Now, to me, it might be of limited value. If you're donating up to 100% of your AGI, now your donations are taxed, is an itemized deduction, right? It's deductible. But what would your taxable income be? Well, I can pretty much guarantee you your taxable income is going to be zero, right? If my AGI is 100,000 and I donate 100,000 in cash, then I can count on my taxable income to be zero. Do I want to get my income down to zero? And that sounds nice, and it sounds like something I could be bragging about, but maybe it's not the most efficient use of donations, because you're utilizing charitable contributions to offset income that's maybe taxed at a fairly low rate. Right? Your capital gains rate is zero, right? But I guess you wouldn't get there with your AGIs at 100K, but you do have lower brackets. You have 10%, you've got 12%. Is that an effective use of your donations rather than still spreading it out in multiple years if you're giving that big of a donation? So I'm not sure how many of my clients are going to be up for donating 100% of their AGI as a cash contribution. It's similar to what you'd be doing with it really puts you on par with the IRA to charity transfer, right? The charitable gift distributions from an IRA, it would be no different, right? And I like that for some of my clients who don't otherwise itemize. I think it's a great plan, but I do think that donating appreciated property, where you're avoiding capital gains, even though you've got a 30% AGI limit, but the fact that you can avoid capital gains and get the deduction, and to the extent it exceeds 30% of your AGI, you've got a 5-year carryover. To me, it seems more tax efficient, that you're offsetting taxes at higher rates, and in that example, avoiding capital gains tax. I think so that has to be looked at carefully. I'm not sure how many of my folks are going to be are finding that to be something that's very attractive. So you can still consider, excuse me, you now have the opportunity to make up to $300 above the line deduction for charitable contributions. That's a fancy way to say that you can deduct $300 of a charitable contribution, even though you don't itemize your deductions. So for what it's worth, you get a $300 deduction if you don't otherwise itemize. Now for my C corporate clients, typically charitable contributions are limited to 10% of taxable income. I normally recommend my C Corp clients to make all their donations personally. Right? It's just the 10% limit's pretty low. The rates are now at 21% in C Corps. I recommend they normally make those contributions outside their C Corps. Of course, a lot of times that's where the money is. But now the limit's at 25%. So maybe there's some more incentive to do that. Some of my folks got decent sized carryovers, so free up some of that in 2020. And I'm sorry, I can't recall if these are permanent changes or not. I can certainly check on that and let you know if you want me to tell you. All right. So I'll spend the next 10 minutes or so on these last 2 or 3 items. And like I said before, from a CPA's perspective, these items I'm going to talk about are really what move the needle for some of my clients. They create large tax deductions and save a substantial amount of tax for the right client, for those who fit in this model. So what happened was they changed the rules for net operating losses. Now, what's the problem with the net operating loss? Well, the problem is you have to have a loss, right? Now, a lot of times we can manufacture losses. We can create those based on tax timing and depreciation. There's things we can do to make that work, right? But by and large, if you're continuously losing money, then I don't think that's any business model you should be proud of. But if you are able to create losses through, again, timing of income and deductions and depreciation, which we'll talk about, then this is a fantastic opportunity to now save a whole lot of tax you may have paid up to 5 years ago. All right. So when the Tax Cuts and Jobs Act came out, one of the changes they made was to eliminate the carryback of net operating losses. So under the old law, you could carry back a business loss, but you can carry back 2 years or carry it forward 20. And under the TCJA, they said, well, we're going to eliminate the 2-year carryback, but allow you to carry it forward indefinitely. All right? So it created this problem where if you had losses in 2018 or 2019, there's nothing you could do. You couldn't carry it back. All right? Well, now they've said if you have losses in either 18, 19, or 20, then those losses can be carried back up to 5 years. Now, I was very careful to point out this applies to 2018. So what does that mean? So that means, well, that means that I've got a number of tax returns I have to go back through to find out if we need to amend returns to carry losses backwards, right? We then have the opportunity to carry it back from 18 back to 2013. And to me, that seems like a great opportunity. And I've got a couple of folks where this is some big dollars. They had large losses in 18. They're expecting to carry forward into 19, but the amount of tax they were paying in prior years was substantial. And what else were they paying? They're paying at higher rates, right? Tax Cuts and Jobs Act, it cut taxes. It's in the name. We already know that, right? And so the opportunity to carry net operating losses backwards is a huge benefit for my clients. Now to get this completed, you've got to file a Form 1045. It's a carryback claim. It can be faxed in. It's funny that I'm excited about a method of submitting a form on technology that's 35 years old. Bob would probably like that. But yeah, I'm excited about being able to fax it in. And they're doing that because of the coronavirus, right? A lot of the IRS is shut down. They're slow on processing lots of things, including refunds. Right. But there's some technical issues from a CPA standpoint we've got to be careful about to make sure our clients are being served as best they can. So if you're going to do a carryback claim, you can do it on a Form 1045. The reason that one's important is because the IRS is compelled to respond to those quickly. They have to process them fast. There's rules against just sitting on them like they can for other amended returns. All right, so you have until June 30th of 20 to fix a 2018 return. Well, that's we got 19 more days. Then we have to consider then waivers of carrybacks in 18, 19, and 20. Now you file the waiver. So let me be more clear. You either can carry it back or carry it forward under this new rule, right? You can carry back 5 years. Now you can elect to waive that carryback. You don't have to do it, but you've got to tell the IRS you want to waive the carryback. Otherwise, they force you to do it. And there may be some tax inefficiencies for carrying back an NOL in certain tax years. So there's a lot of things we got to now go back through on our clients. This is one more thing to figure out for those who, for 2018, and for those who may have already filed for 19 or not filed, how this new rule applies, okay? And it applies to individuals and C corporations. And again, for both individuals And for C corporations, the rates were cut, right? Especially for C corps. The rates went from 35, effectively 35 down to 21. So this is a huge opportunity, okay? And the reason why I think it's even more important is that there's, we'll talk about in a moment, or some opportunities to create losses under the changes in the law, right? Now, the Tax Cuts and Jobs Act created 100% bonus depreciation. And the reason why that is so cool and why they made the change was that it applies to both new and used property. Before it had to be brand new, newly manufactured. Now it just has to be new to you to get bonus depreciation. And even if you didn't know what bonus depreciation was, if I stick the word bonus in front of the word depreciation, you got to think it's something pretty good. Usually bonus is a word, if it's preceding another word, is something good. It's not like it's, bonus years added to your sentence for jail, right? It's usually something good. So bonus depreciation allows us to take 100% depreciation on assets that have a useful life of 20 years or less. And that covers a lot. Basically excludes real property. Now, in order to perhaps stem the tide, or to, I wouldn't say eliminate the benefit, but if you have 100% depreciation, apologize, then you have the opportunity to create some huge losses. And Congress saw that coming, so they limited the amount of loss you can take from your business to offset other income. And that's what this whole idea of what they call excess business losses is. So you buy a $5 million plane in your engineering firm, and you typically have $1 million profit, and suddenly you can take bonus depreciation for $5 million, you get a $4 million loss, right? And so they wanted to cap that. And so Congress said, well, if you have excess business losses, we're going to limit those to $500,000 for joint filers and $250,000 for single. So it really limited the amount of loss you could take, and that's why they did it. Okay, but under the this new tax law, they've eliminated the cap on excess business losses. In other words, we can write off that airplane and not have to worry about the limits on losses on it. Well, this is fantastic. So I don't have to worry about the limit on the loss, and I can carry it back 5 years. Well, I'm going plane shopping next week. Well, I'm not, but you get the idea. So you've got opportunities in 2020 to do some tax planning to create losses this year that perhaps you can carry back to prior years and unlock tax you paid as far back as 2013. It's a huge issue. It's from an accountant standpoint, these are major headaches. We go back through and sort through which clients we had limited losses on, or perhaps we weren't as aggressive on depreciation because we knew our losses were going to be limited. Okay, so that's a whole other discussion. Is perhaps revisiting your method of depreciation and changing that if you have the opportunity. And that's why my last bullet point reads major headaches, but potentially big refunds. It can be really big dollars. Not all our clients have airplanes, but they may be real estate professionals, okay? Or they may have opportunities in their business to write off equipment that we're otherwise eliminating. And so, again, from an accountant standpoint, the net operating loss provisions and the excess business losses are huge opportunities to save our clients money. Now, one last thing I want to talk about in that related to that is a change to qualified improvement property depreciation. So when the Tax Cuts and Jobs Act came out, they made a mistake, right? Which is not uncommon. It was a drafting error, and in reclassing how different categories of depreciable real property were depreciated, they messed up, right? And so they got rid of 3 different classes for leaseholds, for retail, for restaurant property, and combined them into what's called qualified improvement property. And the intention was to make this all 15-year property. Why it's important that it's 15 years is you get bonus depreciation. And again, you guys like bonus depreciation because I told you, plus it has the word bonus. Oh, and by the way, we can write it off all in 1 year. Well, they messed up and they tied it to a 39-year life. Well, at 39 years, it didn't qualify for bonus depreciation. And back in the filing seasons for 19 and even this year, for 2018 and 19 returns, we didn't know if this rule was ever going to get fixed. It was a clear drafting error. Congress even said so. 2 legislators proposed technical corrections that encompassed 1 code section, and that was it. It was 1 paragraph, practically 1 line, and it was, you know, sponsored by a Republican and a Democrat, and they still couldn't get that through, right? And it's sad. So it took a pandemic, it took coronavirus to give some stimulus to the government to fix this error. So they fixed the drafting error. So qualified improvement property is now set at 15 years. And they made one little change to it that affects how much we can write off. But we don't have to go into too much detail here, but suffice to say, they righted it wrong. They made it 15-year property. So if you're a building owner, a commercial building owner, and you're doing tenant improvements for your tenants, then all those improvements can be depreciated in 1 year. It's called, again, through bonus depreciation. Huge change, right? Before we could have done Section 179 expense for that. It was capped at $1 million. It's a problem with Section 179. With bonus depreciation, there's no cap. It's unlimited, right? And it's 100%. And you can create a loss out of it. Whereas with Section 179, if you had a loss, then the 179 deduction was unusable. It just carried forward. Okay, so that's a big issue. So I'm going back through my returns for 18. I know I filed a number of them, assuming the law was going to get fixed in time. And I guess I'm more of a futurist than I thought. I just knew they were going to fix it. I just didn't know it was going to take 3 years. Okay, so I've given you an example here of why this is so powerful and why it's so important. So let's say a taxpayer owns commercial real estate and paid $1 million for improvements on the property on January 1st, if that was possible, in 2018. So under the old law, it was depreciated as if it was real property. It was depreciable over 39 years. So out of $1 million we paid, we got a $25,604 deduction, and we were going to get that for the next 39 years. So that meant what? You know, we were going to tear up our DNR. We knew we had 39 years of depreciation. I wasn't going to leave until we got every last bit of it. Okay. Well, now we can take that entire amount all in 1 year. It's a $1 million deduction. So what's the tax savings at 35%? It's $340,000. Are these big dollars? Yeah, absolutely. Now you can only depreciate something once, right? You get $1 million of improvements. You can write off one time, but over 39 years, things can change dramatically. And what could happen in those 39 years is the owner or a spouse could pass away. We get a step up in basis. We get another bite at the apple for depreciation. And everything you took before that is as it was as if it never happened. So in my experience, I think that there are folks who leave a lot of money on the table for not considering methods for depreciation, for not looking at something called cost segregation studies or component depreciation, identifying property or components of a property that can be depreciated over a shorter useful life, either through, and perhaps pulling in bonus depreciation or some other method to accelerate those in earlier years. Again, so if we're going to have clients I know that have this issue, and we're going back and looking at them now, we're going to be able to create losses or add to our losses. Since now we don't have that same limit, we can do a 5-year carryback. Okay. So a lot of these rules are benefiting. They're benefiting those who are in real estate professions. So real estate professionals. Okay. So I've given you what the requirements are to be a real estate professional. Okay. These are all your real property trades, your contractors, developers, agents, brokers, all those. They don't have the same limits when it comes to deductions on passive losses. Or if you're a financial planner, attorney, and accountant, you're limited, right? These folks are not. So they get large deductions that are not capped based on adjusted gross income. They're not capped based on dollar amounts like other folks are. And with the fact that we have unlimited losses and 5-year carrybacks, there's fantastic opportunities here. And perhaps it's no coincidence this is really helping those in real estate. All right, a couple other minor provisions of CARES. Employers can pay up to $5,200 towards an employee's student loan tax-free through 2020. It's excludable for income and payroll taxes. The individuals who have student loan payments, they can be deferred until September 30th, but you got to contact your lender. They're not telling you about it. Right? They're not in any great hurry to let you know. All right? And HSA and FSA funds can be used for over-the-counter medication. Right? And then finally, one thing I did not have on there was for those of you who have SBA loans on buildings or otherwise, the SBA was deferring, well, I should say not just deferring, but forgiving 6 months of payments on SBA loans. And it was and this is truly tax-free also. Now, they were telling you about it because one or two of my clients called me and said, hey, I didn't get, I don't think I had, they didn't do the automatic withdrawal from my SBA loan, all right? So that was another goodie, if you will, as part of the CARES Act. So California, what does California do? Well, California does its own thing, if you will. I've given to you the list of tax law changes for which California has conformed. I'll give you a moment to have that, just to kind of let that wash over you and absorb all the information I've given you right there. Okay, it should just take a moment. All right. Well, I think I just carpet bombed you with a whole bunch of technical issues on the CARES Act. And at this point, I'd like to open up to any questions you might have, and anything that you might want to share, or I can share to the group regarding the CARES Act. All right, I got a couple questions here. Just give me a moment to look it over and formulate my answer here. All right, so the question is, in your example, regarding distributions from a traditional IRA, could the participant withdraw $90,000 from her traditional IRA as a coronavirus-related distribution in 2020, pay taxes ratably over 3 years, and then roll over the $90,000 to a Roth within 60 days? And there's a parentheses here. I'm trying to make sense of the interplay between the CARES Act and normal rollover rules. Thank you. So my understanding is it has to go back into your traditional IRA. You could have done the Roth conversion, I think, if you did it within 60 days of the money coming out. I think that's one of the caveats there. So I think as long as you get it back into your traditional IRA, you're okay. If you took the money out of your traditional IRA, when I get it to the Roth IRA, I think you've got a 60-day window to meet that rule. So I don't think that's going to work for you. All right. Next question is, if you defer RMDs into 2020, will you be required to take double the amount in 2021? That's an excellent question. The answer is no. So how do they make the calculation? Well, it's based on the value of your account at December 31st of the prior year. So at the stroke before midnight, whatever the value of your account is at the end of 2020, then that's the basis for determining your RMD in 2021. So they won't make you double up that payment. It's not like they're going to make you calculate that and keep that aside and then pay tax on it again. So. Okay. Any other questions? Go ahead and type in. I'd be glad to address those for you. I know we're at about 3:15. I promise we get off a little early. Again, my opinion is that we're going to see a lot more refinement. You can see more changes to the CARES Act. I think they're going to be looking to make it easier again to avoid the 10% penalty on the coronavirus-related distribution. I'm not sure they can make it any better in the depreciation world. They've kind of given us everything we need. But are we out of the woods for stimulus? I don't think so. Not from what I'm hearing. They're proposing additional packages for this, and who knows what they'll come out with. At some point, I guess all this stuff has to get repaid. That's the only part that concerns me. But for sure, you'll see more updates on some of these rules. There's a lot of things left open to interpretation, especially as it relates to the coronavirus distribution. Just too many things are unknown, and we have some time to figure these things out, but the clock is ticking. So we'll just have to do the best, as always, do the best we can with whatever we have. So. And I'd mentioned California conformity. Again, at this point, they have done absolutely nothing as they normally do. But I think their days of sitting on the sideline forever, maybe, I mean, they certainly can do that. I think California has to do some things as well in the tax area. Although I guess our budget surpluses have gone away very quickly here, so who knows? So. All right. Well, I can't see your bright shining faces. I can't see if you have more questions that are rattling in your head, but I don't see any more on my list here. So I want to thank you for taking the time to be here with me, and take this opportunity to thank also the Eldorado Community Foundation, Bill Roby and his team, Sakina, Lois, Kathy, and Chris. Those guys do a great job up there. If you're in Placerville, I guess it's harder to just stop in and say hello. But I would definitely encourage you to reach out and find out more about the foundation if you can. If you have any questions, you always can contact me. My contact information is on the slides. If you'd like a copy of the slides, I'd be glad to email them to you, and they'll be made available through the foundation. Okay? If there's nothing else, then I'll bid all of you adieu. Thank you for your time today. Enjoyed it. Let me know if you have any questions. Thank you very much.